Okay, so tonight we're doing chapter 3 from the financial accounting class. We're just going to do a review of that because it kind of gives you all the information with the financial statements again and all that, the format. And also we'll go into some entries. So, first, we're going to talk about the timing. So in business, you will always have some time period for your cycle. A lot of times it's the calendar year. So you start your year off in January, end on December 31st. But it doesn't have to be that way. A lot of retailers, they'll do their, they're closed for their year end. Could be, January, maybe it's after they've gone through their Christmas season. It could be right before. So it depends on the business and why they would decide to do that. And you can elect to do that in order to, have it in the way that you want it to be. So it's just a 12-month cycle usually, okay? It doesn't have to be calendar. It's just either the physical year, which is 12 months, or the calendar year, which is also 12 months. This doesn't follow January to December. It's all the physical year means. So we also have interim financial statements. So potentially you'll work for an organization that will prepare financial statements monthly. So every month you'll make sure that all those adjusting entries are in, all your depreciation entries are in, and all of the sales are recorded. If you don't have some invoices, you accrue for those invoices, and they do that every month. They'll produce all the statements and send them out, or they'll use them for internal use. You don't have to have financial statements every month. Not every organization does it that way. So my organization, we do them quarterly. So we have calendar year. And so every 3 months, we're closing out everything. We're putting together financial statements, doing our entries, doing variance reports. And so that's how we do it. It's quarterly. It's 4 times a year. You may be able to work for an organization that does it twice a year or annual, which is unusual, but sometimes companies do it that way. So when we see interim financial statements, that means it's something in the interim. It's not the end of year. It could be the first quarter, second quarter, third quarter. It's interim financial. All right, so accrual versus cash. So do y'all remember what that word accrual means? Do y'all remember hearing that word? I know some of y'all said it's been a little while. Do you remember hearing the word accrual? Do you remember what it means?
Just like over time.
Yeah, so it's so what you want to do, instead of saying, oh, I have some cash that came in right now, I'm going to go ahead and book it as a sale, or I'm paying something out right now, maybe it's an insurance policy for a whole year, so that's going to be my expense, what I paid out. That would be a cash basis because you're following what the cash is doing, and that's what you're putting on your books as your expense. With accrual, that basically just means that you're going to be trying to record your sales when your sales are actually happening, and you're going to record your expense in the period that it goes with those sales. So if I buy an insurance policy that's for 12 months, that policy is bringing me benefit over the course of the whole 12 months. So our policies and insurance, when we pay for them, they run from about May to May. So from May to May, I have insurance that's going to benefit me if something happens. We have, like we just had Hurricane Ida. So my insurance will cover some of those losses. And, I could have something happen at one of the buildings, which we do. Unfortunately, people run into buildings all the time, more than you would like to know. But people will run into your building and cause damage. So you have your insurance. And so when that happens, you'll have benefit of that insurance policy. So instead of saying, okay, I'm paying $12,000 for this policy, and that $12,000 is for a year. I bought it in May, so I'm going to expense the whole thing in May. So instead of doing that, because I have benefit over the whole 12 months that I own that property and I have that insurance policy, I'm going to divide it up. So over 12 months, $1,000 a month is going to get expense. Okay, so that's what accrual means. It's just, I'm going to take that expense, I'm going to push it over time. If I know work was being done on a building, let's say somebody came out to paint those repairs, and They did it in December, but I haven't gotten a bill yet. I'm closing my year and I know that work was done. I'm gonna go ahead and accrue for that expense. That just means I'm getting that expense in the month that they actually did the work. It's matching those times that they actually had, I had benefit from it in that month. So if I have sales, I want to record those sales when they actually happen. Sometimes we may collect money, but we haven't done anything yet for it. So think about ticket sales for a concert. So when you collect those monies, you haven't done your concert yet, right? You haven't gone to the concert. Usually for months, you buy months in advance. So that's just an unearned revenue. It sits on the books as a liability. I owe something. I'm going to owe that concert, or I'm going to owe that money back if I don't have that concert. So I have to show it as a liability. I don't record it yet as income until it actually happens. So again, that's what happens when you're using accrual accounting. Okay, so you kind of understand it's not just when the cash comes in or leaves. We're actually looking at where is the money coming from and why, what's it for, and then we're going to adjust accordingly. What are we spending money on, and is that benefiting me now or in the future? We're going to put the expenses in accordingly. Okay, so we talked in the first principles class, we talked about the revenue recognition principle and the expense recognition principle. And it's basically what I just talked about, right? So we're going to recognize those revenues when we need to recognize because we've done something, we've sold a product or we've done a service, now we can record that revenue. And the expenses, we're going to try to record those expenses when those revenues happened or when I'm benefiting from that expense. So that's what the expense means. So it goes along with the accrual process. Now, cash basis, if I was putting a financial statement together for cash, on a cash basis, then I'm looking to see, well, how much did I collect and how much did I spend? So the money coming in is my revenue. The money going out is my expense. So hopefully I have more money coming in than going out, right? But I want to get into that being upside down and having loans. Okay, so when we do these entries, so when I pay for the policy in May, each month I have to do an entry for my expense for that insurance policy. That's called an adjusting entry. So we talked about source documents last week. Source documents are, like an invoice comes in or a bill comes in and I have to pay that bill. I'm putting it into the system. Or I have a sales invoice that comes through. I know I got to process that, put it through, and I'm going to be selling some products. So there's going to be source documents coming in throughout the month to do something. And then I have these other transactions that maybe I've already done. And I have to remember, oh, okay, I had that expense. I got to set up a journal entry to put the expense in, but we haven't gotten that bill yet from the vendor. So I have to put that in. That's an adjusting entry. I have equipment that I'm using in the plant and I need to depreciate it. Each month that I'm using it, depending on my method that I set it up, we have lots of different methods. We're only going to talk about straight line. The first class went into all these different methods of depreciation. So we take that depreciation, we expense it. So I'm not buying anything. I don't really have a source document coming in. There's none of that. I have to do an adjusting entry. So that's what an adjusting entry means. It just means that I have to record something on the books. Maybe it's that concert came to fruition and now the concert's over. So I have to recognize part of the money that I collected for multiple concerts. I have to recognize that now as revenue. So I do an adjusting entry because I don't have sales coming in. There's no transactions there. It's just already on my books. Does that make sense? So that's what an adjusting entry is. We're just making adjustments based on usually something that's already happened or something that's come through that I need to set up for the future. All right, so we talked about some of these. So the first one is prepaid expenses. I talked about insurance. So let's walk through an example with insurance. So I have a policy that I paid for $12,000. It's for 2 years. So how do I want to set that up? I'm going to go ahead and set it up that journal entry it's my adjusting entry because I've already paid for it. We're not looking at that part. All I want to know is what is my adjusting entry going to be, let's say for 1 month. So I'm gonna take that 12,000 and divide it by 24, because it's 24 months. And that tells me how much do I have to expense each month. So if it was 1 year, it would be divided by 12, which would be 1,000. So we're doing 24 months, so it's 500 a month that I need to expense. So I'm gonna do an adjusting entry to insurance expense for 500. Okay, so let me just start, let me back up just a little bit. Let's say it's January and I paid 12,000. So when the cash goes out, I know that I have to reduce my cash balance. So part of my entry is going to be cash, right? We always have a debit and a credit. We talked about the format of a journal entry last class. We have the debit first and then indent on the credit. So when I buy this policy, I know my cash is going out. So that's going to be my credit. The debit is an asset account. I've paid for this and it's going to benefit me in the future. So I'm going to set the whole amount up to prepaid insurance, or maybe it's some other type of expense. So prepaid expense. It's something that I've paid in advance that's going to benefit me over a period of time. So I have this on my books as an asset. And over time, I'm going to reduce it. So the adjusting entry is going to be to clear this out to zero over time. So this first month in January, because it's good for January, I'm going to expense just 1 month. So on the beginning of the year, that 1/1 entry is to interest expense 500, and then I'm crediting prepaid insurance 500. So over time, this 12,000 is going down. So it'll disappear. That account will go away in 2 years. Does that make sense? No questions? So that's a prepaid expense. We also have supplies. So we can prepay for supplies. Maybe I buy a bunch of supplies up front. Maybe I bought a bunch of paper. And it would be the same thing. I bought the paper, so I'm bringing it in as an asset supplies. My cash went out, that's my credit. That's my entry. Now, as the months go by and I use those supplies, I have to reduce those down. So I would expense it, supplies expense, just like I did insurance expense, that's my debit. And then my offset to that would be supplies. So let's say I bought $2,000 worth of supplies. And the first month I used 500. It would basically look exactly the same, it's just different accounts. Supplies, expense, 500. Now I'm reducing my supplies because I want that account to go down. Okay. We can do the same thing with rent. A lot of times people will pay rent in advance for 3 months, 6 months, maybe a year. And so we can't record all of that money as income yet because they haven't been there the full amounts of that money, however long it is. Let's say it's 3 months. So I don't want to record that as rental income yet. So I just put it on my books as prepaid rent. And then each month we'll issue a credit to that tenant to credit for their rent for the month, for that month over the next 3 months. So what's the entry look like? It's going to look basically the same way. Instead of being, let's say it's us, we paid 3 months rent. So we're going to do rent expense. Let's say it's $1,000. And then I'm going to back out that prepaid rent, $1,000. So I'll get credit for that in advance when I pay it out. And then as the months go on, each month that I have to pay $1,000, maybe I paid $3,000. So each month I'm going to do this entry where I'm recording my expense and I'm just decreasing down that prepaid rental account. Let's say it's prepaid rent. And depreciation does basically the same thing. We're going to go over depreciation in a little bit. So I'm not going to show an example yet. Okay, so any questions about that when we're expensing? Okay, so the note on here says, number 3, it says the journal entry is to increase your expense and decrease the asset. So the asset carries a normal debit balance. So when I purchase an asset, that means I'm putting it on the books in that debit column. So it's sitting as a debit. That's my normal balance in an asset account. When I have an expense, the normal balance for an expense is a debit. So that's why I'm saying we're debiting expense. If I say that I need to reduce an asset, so I'm reducing that prepaid or that cash, I'm saying I'm reducing. If it has a normal debit balance, well, how do we reduce it? We're gonna have to do the opposite. We're gonna have to do a credit. So we're gonna credit the asset account, whatever it is, cash, prepaid, whenever we have an asset that we have to decrease, it's going to be a credit. Does that make sense? Okay. So on your journal entry, you're going to increase expense and you're going to credit your asset, which means you're decreasing the asset. Okay, so let's look at depreciation. So like I said, we're going to do straight line, which means we're just going to divide it over however many years it is. So we're going to allocate the plan assets over a period of time. So we need to know, what is the useful life? If I'm buying equipment, I'm expecting to be able to use it for some period of time. I usually have an estimate of what I think that is. You can change estimates. So let's say I think it's going to be 5 years, and then I'm not going to be able to use it anymore. But maybe I'm getting to 4 years, and I'm like, you know what, this equipment's working pretty good. I'm not ready to buy something yet. I can still get parts for it. So I'm going to go ahead and change the life. You can do that, and you can re-estimate it and adjust your entries accordingly. We're not going to get into that. I just wanted to let you know that you could do that. And then we have something called a contra asset account. Not sure if y'all remember that term, contra asset. What it means is it's just the opposite of what the asset normally is. So depreciation for equipment, we're not going to touch our asset accounts when it comes to depreciation. So I may buy a building, I may buy a car, so I have an auto account, which is an asset. I might have equipment. So those accounts, when I set it up, so let's say I buy a car for a truck for $10,000. When I set up that auto account, that asset, it's going to be set up for $10,000. I'm not going to do any entries to that account. So remember, we talked about the chart of accounts. You have all these listings of different accounts you're going to have. You're going to have account numbers and you'll have account descriptions usually. So if I have an asset on my books that's a vehicle, it's going to sit there for that amount. It's not going to be adjusted. What happens when I depreciate it over time, I use something called this contra asset account. So let's say it's for a vehicle. So I'll have my vehicle set up for $10,000. When I do my depreciation, I'm going to go to my depreciation expense because that's considered expense, however much it is. Let's just say it's $1,000. And then instead of reducing the vehicle, it's going to be accumulated vehicle depreciation or accumulated equipment depreciation. So it's going to have a separate account that's offsetting it. So it's still going to show on your balance sheet with your assets. You'll have your fixed asset, whatever it is, and then you'll show you depreciation reducing that number. Okay, so you can have multiple different ones. Usually when you're looking at a financial statement, you'll see multiple assets, but you might only see one lump amount that says depreciation, accumulated depreciation. So it won't break it out for each category. Usually it's just one. So in this case, my vehicle will be sitting on there for $10,000. Accumulated depreciation for vehicle would be $1,000, where it's reducing it. So my net book value will be $9,000. Okay, so I'm not using the vehicle account, but I am reducing it using this contra asset account. Does that make sense? So the debit's sitting in vehicle, all the credits are going to be in this accumulated account. Okay, and then this is what my expense is, the depreciation. All right, so let's look at an example. So we have $100,000 that we paid for an asset. It has a salvage value of 5,000 and its useful life is 5 years. I need to do at a journal entry. So let's say I want to do the whole year. So let's figure it out. So first we're going to have the asset value minus the salvage value over the useful life. That's how we're going to calculate how much it is. So we have 100,000 that we paid for it. It's going to be worth 5,000 at the end of that 5 years. And then I'm going to divide it by 5. That's how I'm going to calculate how much it is for each year, because I'm dividing by years, not months. So it'll be 95,000 divided by 5. So we have 19,000 per year that we're going to depreciate for this asset. Okay, so you know how to calculate that out. So it's just take the asset value less the salvage value and divide by useful life. So the adjusting entry each month, or each, let's say we do it annual, and we do our depreciation annually. Most companies that I worked at, we did a monthly, but where I'm at now, we do it annually. So we're going to do depreciation expense. We're doing the whole year. So we're going to do the whole 19,000. And whatever this asset is, it's going to be the accumulated depreciation of whatever that asset is, vehicle, equipment, building, whatever it is. Okay. So that would be my annual entry to adjust my assets. I have to adjust because they depreciate over time, right? They don't stay brand new. And this, I remember when this building was first built and it was brand new, and when you walk through, you can definitely tell it's not brand new anymore, right? It depreciates over time. And you can do improvements. If you do improvements, depending on what you do, that may be set up as an asset as well. Sometimes it's just repairs. But if you're doing any kind of structural changes or changes, major changes to the outside or the roof, those things are considered improvements, and you would set those up as assets as well. And then you would keep track of them the same way. You would depreciate those over time. Do you remember what asset does not depreciate? If I purchase this, I won't depreciate it on my books. It doesn't decrease in value. Do you remember what that is?
Real estate?
Well,
Buildings?
not buildings. Buildings will depreciate, but you're on the right track.
Land?
Land. So when I buy land, the land is not going to depreciate. We won't do any depreciation entries for land. Land usually appreciates in value. So the land will go on the books and then it just stays there. You don't adjust it. And when you buy a land with the building together, which is usually how they come, right? You have land with the building on it. You usually allocate a portion of the purchase to the land. So you don't get to depreciate everything that you've just spent. You only get to depreciate a portion that's been allocated to the building. So usually about 20% will go to land. Okay, so deferral of revenue. Unearned revenue, this we kind of talked about with the concerts. We have a concert and we didn't, we collected the money because we're going to have one in the future. We haven't done it yet. That's considered unearned revenue. I didn't do anything yet to get the money. I just collected. So that's my unearned revenue. So let's look at an example for that. So we earned 1,000 of unearned revenue, and I want to know what is the entry going to be. So we collected some money up front, and it's already on my books as unearned revenue. And what I want to do is make an adjustment to recognize a portion of it. So maybe I collected some money up front for services that I was going to provide for accounting. So now I went to the place of business, I performed my services. So now I know that I can claim $1,000 as income. So my adjusting entry for that, let's go back one more second. Unearned revenue is what kind of account? Do you think that's an asset, a liability, or an equity account? Unearned revenue, think about what it is. Liability. I'm gonna owe in the future something, a service or their money back. So it's a liability. What is the normal balance for a liability on the books? What'd you say? Did you answer? It's either a credit or a debit. Which one do you think? Just guess. Credit. So our liabilities, let me write it kind of over here. So we have assets. They have a normal debit balance. I say normal because there are occasions, obviously, that you have to put a credit in for asset, but usually when you're looking at an asset account, remember I said you can run the ledger, you can see the balances, all the accounts with the balances. When you're looking at asset accounts, you're usually going to see a positive number to debit. When you get to your liability accounts, you're going to see credits. So your liability will have a normal credit balance. And then let's look at expense and revenue. So expenses, we talked about this. When you do those entries, we're doing what? A debit or a credit for the expense to record it. Think about what I had on that last little notch up here. So remember, journal entry, we increase expenses and we decrease assets. So when we increase an expense, is this a debit or a credit right here on that entry? It's a debit. So normally, the expenses normal balance is going to be a debit. And revenue, it seems kind of weird. I'm bringing money in, but it's shown as a credit. Doesn't that seem kind of weird? It's kind of backwards. But a revenue, the normal balance is a credit. Okay. So I just wanted to put that on there so you can keep that in mind. So if this is a liability, if you know this, that'll help you. Okay, so when you see unearned revenue, I know this is a liability and I'm like, okay, I know liabilities carry a normal credit balance. So when I am doing an adjusting entry, if I'm expecting this to have a credit balance, how am I going to reduce it in my entry, a debit or a credit? Think about basic math, right? We have a negative number. If I subtract another negative number, that's going to do what? It's going to add, it's going to increase. If I take a negative number and add a positive number, I'm taking the difference, it's going to decrease, right? So I have to do a positive number, which means I'm doing a debit. Does that make sense? Does that help? Okay, so for this entry, because my unearned revenue is on the books as a credit, it's, let's say it's $10,000. Well, now that I've earned 1,000 of it, do I need to have it on the books for 10,000? No, I need to reduce it by that 1,000. So I'm going to do a debit to unearned revenue for the $1,000. So now the balance has a negative 10,000 and a positive 1,000, which means my ending balance is negative 9,000. So I've reduced it. And then what am I going to do now? I have to record it as revenue. I have to recognize this now as money that I made. And where these pull to are two different financial statements. So on my balance sheet, we talked about last week, balance sheets have assets, liabilities, and equity. So this number is sitting on my balance sheet and we don't wipe it out at the end of the period. It stays and carries forward. So we are going to see those assets and liability balances on that financial statement, that balance sheet. And so last month, I saw unearned revenue had 10,000. So I'm like, okay, she owes $10,000 to somebody. She either owes cash back if she doesn't do it, or she's going to have to do a service. But then when I look at the financial statements this time, I'm gonna say, okay, it's 9,000, she provided some services. So you see how that carries forward. This right here is on, it's income, so it's on your income statement. So all of your revenue and your expenses on your income statement. So what do you pay taxes on? Your income, right? So I wouldn't pay anything on this unearned because it's not revenue yet. So when I'm ready to record the portion that I've earned, now I can move it over into my income statement as revenue. And my expenses will offset that revenue. So I don't pay taxes on the 1,000. I pay taxes on the net income, which is the difference between the revenue and the expenses. Okay, so this is what my journal entry would look like. Debit unearned revenue, 1,000. Record a credit as revenue for 1,000. So that's how I do an adjusting entry for unearned revenue. Okay, so we talked about accrued expenses a little bit. I kind of mentioned to you, sometimes we know that something happened. Somebody came and did a repair, or I know that I was provided electricity or water, but I haven't gotten the bill yet. And so a lot of times what happens, do y'all look at y'all water bill or energy bill? Do y'all pay those kind of bills? Okay, so does it normally run from the first of the month to the last of the month, and then you pay that a little bit later? Not usually, right? Water bills, electric bills run like weird dates. You know, it could be from, 11/20 to 12/20. So I have a few days in there at the end of the month that I know I was provided water, I was provided electricity, but I haven't gotten the bill yet, and I won't get the bill until the end of January. So I need to allow some kind of expense in there. So that's an accrued expense. I am going to accrue an amount. It could be an estimate, or it could be an exact amount. Maybe I know the guy came out, he did the painting, he gave me a quote, it was $10,000. I know that's how much the bill is gonna be when it comes in, but I just haven't gotten it yet. I wanna show that expense because I wanna put it in the month that the expense happened. So I'm gonna do an accrued expense. It can also happen with salaries. So when we get paid, a lot of times our weeks may run, Wednesday to Tuesday. And then sometimes in that week, the month changes. So the same thing could happen. I know that I have my employees there working. I'm gonna owe them, but it's not time to pay them yet. I'm paying them in 2 weeks. So I need to record an expense and get some of that on my books. So I have to know how to do those adjusting entries. It could be with interest. So if I have a loan and I'm paying out a loan, I'm gonna owe some interest, and maybe that loan hasn't paid yet until the 10th of the month. So I know I'm gonna have, some days in there, 20 days that I'm gonna have to accrue for the previous month. That's gonna be included in January because I don't want the whole expense to go in January because that period of time was from December to January. So I need to take the 20 days in December and the 10 days in January and do it that way. That's kind of an example. So we have interest. We can do rent as an accrued expense. We can do taxes as accrued expenses. So let's look at an example. We're going to accrue interest of $500. So what do y'all think the first the debit's going to be? What do you think an account would be called if I have to accrue expense for interest? What do you think the account would be called? Let's go back up here. Somebody's going to answer. I'm not letting y'all off that easy. So we're doing a journal entry to increase an expense and decrease something else. So if I'm accruing an interest of 500, what do you think it's going to be an expense. So what do you think it's going to be called? We're debiting, we have to increase expense. Well, we're doing interest. Interest expense. So we're going to debit interest expense for the 500. And now, did I pay anything? I didn't pay anything. I'm just making an adjusting entry. So I am going to be paying this next month in the future. So remember I was saying, maybe my payment's not due to the 10th of the next month, but I know I have a portion of it for this month, and $500 is that portion. but I'm not paying it yet, but I have to pay it. So if I have to pay it, that means I'm liable to pay. Do you remember what that's called? We haven't talked about this account yet. It's a liability, and I'm liable to pay accounts payable. So now what'll happen is, so this, let's say this is December. The whole reason for this entry is to show whoever's looking at the financial statements, they're looking at it and they're saying, okay, she's got some things that she's gonna owe in the future. So I have to put that on my books, right? I want my financial statements to be reliable, and people are gonna be making decisions off the financial statements. So you should have them accurate, right? So we wanna put whatever we have to pay in the future, we're gonna get those expenses on there. We wanna make sure we have those liabilities on there. Or, you know, assets as well, like what we prepaid. Oh, they down on cash, but look what they paid. They have all these prepaid expenses. Okay, well, maybe they may use a little cash. So it kind of tells a story. So when I do this entry, the whole purpose is to say, I owe that 500 and I had an expense that covered me for this period of time and I got some kind of benefit out of it. So what happens in January when I get the bill? So now I'm gonna pay the bill. And let's say that the total interest is $1,000. So in January, do you think that I'm going to expense the whole 1,000? The whole 1,000 is not for January, right? Only a portion of it. So for January, my interest expense would be 500. But I have to pay 1,000. So I know that this little credit down here is going to be $1,000. So I know that I'm going to be paying out that 1,000. Well, now I'm not in balance. Remember I was saying your debits have to equal your credits. So this totals 1,000. This only totals 500. Well, something's wrong. It has to balance. So do I want to leave this on my book saying that I owe 500 if I don't anymore? No, right? So I'm saying a liability for $500. If I pay the liability, I want to clear it off. I don't want to leave it there saying, oh yeah, so I owe money. So I'm going to clear this payable. So my other entry is going to be accounts payable or accounts interest payable, however you want to call it, for 500. Now, they equal. So I have 500 in expense. I have 500, I'm clearing that liability off. So this is just kind of like a little holding spot, right? For the month until I'm ready to pay it. So that happens with other expenses too. And we use this a lot. So this is something that is very, very common in an organization. When you have a lot of bills coming through that you know that you're gonna have these expenses, maybe you haven't just gotten that invoice yet or that bill yet, you're gonna go ahead and set it up. And so you're gonna use some sort of liability account to say, I'm gonna be paying this in the future. So some kind of payable account. Okay, so this is just a little diagram that shows you your trial balance. So what I wanna point out is that first column of debit and credits is called unadjusted. So at the end of the month, and I'll do this, I'll run a trial balance and I'll get all my accounts and I'll see all my debits and my credits. At the end, I usually check to make sure my trial balance is balanced. On occasion, because you're using software, you can have glitches, you can have something that gets corrupted, some kind of file gets corrupted. And so sometimes your trial balance may not be in balance and you want to notify IT of that. So we'll run reports and we'll look at the accounts. And then we start looking at what did we have for our NTG bill? When was the last time we paid it? What was the date on that? How many days do we have to accrue? Let's look at the water bill. And we do this for all of our properties. We go through and we say, okay, here's the water bill. What about security? Do we pay all of the security bills? And a lot of times we don't have them all. So we have to accrue those, just like we just did on these other entries. They're called accrued expenses. So I'm working off of this. And I may be comparing it to what we budgeted and saying, okay, this looks a little low. This looks a little low. Let's look at these accounts and see what's going on. Did we get billed for 12 months of maintenance for the yard, outside. And then, you might look at it and say, okay, I know this building. I know every year they put up decorations. I don't see a bill for the guy bringing over the decorations and setting up and taking down. So you got to look for certain things. You start learning your organization and what things to look for. So then you accrue. They're called adjusting entries. So we make adjustments. So in that second column right here, it says adjustments. That is the adjusting entries that you make. And you'll notice that you should see them on both sides. So for the 1,800, it's number one. So whatever entry they did, it was $1,800. And I was doing a debit to accounts receivable. And then I need to look down and I'll see where my credit is. This F right here, it's F, it's not one. I just can't see that good. Okay, so I have my 1,800 in my debit column for accounts receivable. Then I'll look on the credit side. I find the F down here. It says 1,800, but it doesn't look like it's going to any account. I'm not sure why it's there with no account. That doesn't make sense to me. It shouldn't look like that. That was a bad example. All right, let's look at B. So we see the credit of 1,050 for supplies. So we've obviously used some of our supplies. We're doing an adjusting entry. We're reducing the asset down, so we have a credit. Now, what are we expecting to see a debit in? Because we used it, it's now what? No longer an asset, it became an expense. So we're looking for the expense. And down here where it says supplies expense, 1,050, that's your offset. So you'll see both sides on those adjustments. Because on those journal entries, remember we're doing debits and credits and they have to balance. So those adjustments should balance. So your trial balance balances, your adjustments that you've done, those balance. And then now we're moving to the adjusted trial balance. So just like it says, now it's got the adjusting entries in it, so it's been adjusted. So we call them an adjusted trial balance. So for the classroom, how you walk through it. And I'm sure at some point in the past, it was this way. You had to do it this way by paper. They don't do that anymore because now everything's in the computer. So what happens is I run the trial balance, we make the adjustments, and then I just run another trial balance. It's not called adjusted trial balance. It's now just whatever was entered is now there on my report. I just run the same thing. It's just now there. Okay, so that's my adjustments. So once I put all those numbers in, the balances in those accounts that were adjusted change, and then the bottom totals should match again. All right, so that's what it looks like once you get everything in the system. You're starting with a starting point, and then you're making those adjustments, and then you're gonna have your ending adjusted trial balance. So that's where you're planning on ending with your books after you make those adjusting entries. Sometimes it's errors you have to fix. Sometimes, maybe I had water and I accidentally stuck it in security and I need to reclass that. So your adjusting entry, all you're doing is moving it out of one expense and putting it in another. So you have things like that that happen. So you make your adjustments and then you rerun it. Okay, we're not going to get into the closing process. I don't know that I have any entries on closing process. The closing process is basically after the 12-month period, whether it's a calendar or physical year. When you are finished that operating cycle, you want to clear out all your temporary accounts. Temporary accounts are all of your revenues and your expenses, your dividends that you paid out. You want to close those because now we're entering a new year. So I can say last year we made $1 million. This year we made $2 million. Well, how can you tell? Well, because we closed out all those accounts and we basically brought everything to zero. And now the new year, we're starting fresh. That only happens for revenue and expense accounts, not your assets. Because think about it, if you had a bunch of receivables, let's say you had 500,000 in receivables and people owed you money, that's what it means, accounts receivable, I'm gonna receive money in the future. Would you want that to just be wiped out? No, you want to see that 500,000 and who owes it to you. And then you may not want to see who you owe, but unfortunately you have to carry that forward too, right? So that you know, who do I owe? Who is the vendors that I owe? What is the total dollar amount that I owe? What do I still owe on that loan? So those types of accounts, those are your permanent accounts. Those don't get closed out. Okay, only your temporary. They're gonna roll into your retained earnings. All right, so this is just a little short classified balance sheet example. Just shows how all your assets are on one side. We have current assets. Sometimes we have non-current assets, which just basically means that that asset is going to be used over a period of time. That's usually your equipment. And so we're going to talk about, in this class, when we get into the managerial class, we focus on organizations that will have equipment like that we use to produce. And we're going to be talking about the cost that goes into that, and the different ways that you can keep track of the cost and different terms. So you'll see how that goes. But for the assets, you'll notice the current assets are things like cash, accounts receivable, things that you're going to be collecting on or can use right away, and convert those other assets to cash very easily. And they're within usually a year. And then those non-current assets are your plan assets that usually have value over the 12-month period. And then on the other side, we have our liabilities and our equity. So again, we have current liabilities, things that are due now. We may have long-term liabilities, which would be like, let's say a mortgage on a building. And you'll show your non-current portion in that section. So you know that mortgages are usually, 15 years or so. So assets should equal liabilities plus your equity. So that's your formula. So whatever this total is should match this total. Okay, we're not going to go over those. All right, so do y'all have any questions about the information so far before we get into like actual problems? Anything that we went over? Anything you want me to go over again that you don't understand? Y'all feel good? Good. Yeah, that means y'all all gonna get A's on the test, right? It's a review. I mean, I know some of y'all said that it's been a while, but I know Matthew's getting an A. He's got to. He had the class last semester. You too. There's another one in here that had it last semester, but she's not here tonight. Did you have principals last semester too? You had, okay. Yeah, she's sweet. I like her. Okay. So let's look at some problems. So did y'all have any problems? I know you have a question on chapter 2. Do you want me to bring the problem up?
Okay. I wrote it down like kind of what it said.
Let's hope it's not like a question that's worded weird.
It kind of was.
It was?
Yeah.
Okay. I know. I try not to grab those problems to put on there, and then sometimes I'll type them and I'm like, that's not what I wanted it to say. It sounds totally weird. Like, what was I thinking when I typed that problem? I've done that on tests because I'll make up stuff on my own. I won't pull the bank questions. And sometimes I pull the bank questions. I'm like, what the heck is that? I don't even know what that question's asking me. So, it happens. It's this class. All right, so do you know the number by any chance?
The number 14.
14?
On homework.
Okay, 14. Okay, so this is it. Okay, so Wiley Consulting purchased $7,000 worth of supplies and paid cash immediately. Which of the following journal entries will Wiley Consulting make to record this transaction? Assume the company's policy is to initially record prepaid and unearned items in the balance sheet accounts. So they want to know what is the entry to buy when you buy them. So we're saying they purchased 7,000 worth of supplies and paid cash immediately. So I know, because they said that I have cash in my transaction. That's gonna be part of my journal entry. Cash is an asset, normally has a debit balance, but it's going out. So what am I doing? Cash, credit. So I know that I have to pick an answer that has cash as a credit. Okay, so supplies are considered an asset because we'll have benefit over a course of a period of time to use those supplies. So when I set it up, and this is one that's got a wrong answer. When I set it up, my entry is going to be to debit supplies. So that's what the answer should be. Should be debit supplies, 7,000, and credit cash, 7,000. So it's a good catch.
Yeah, that one really.
And it doesn't have a correct answer.
I think I did it wrong, but I think I was focused on debit supplies and then I chose the fourth answer.
This one?
It was obviously also not right.
Okay, I'll have to go in. I can edit it and just count it right because it's obviously doesn't have a right answer. So everybody should have that question right. Okay, so when you debit supplies, now I have an asset on the books. I'm going to use those assets over a period of time. It's not looking to say what was the adjusting entry. It's not asking for that. It's saying that you purchased them with cash. If it said that you purchased on account, that would be, that fourth one would be correct. You would debit your supplies and you would credit your accounts payable because you haven't paid for it yet. You have it on account. If you buy something on credit, or if it says you buy something on account, that means that you're setting it up to pay in the future. So now we have an accounts payable. I'm liable to pay in the future. Okay, so that was the only question on it? Okay. Okay, did y'all do homework 2 yet? Has anybody started it? I don't know that I opened. Anybody start chapter 2 yet? I thought I opened the practice test. Okay, so let's look at some of this study guide. So this is a study guide I put together when I put together the test last time. We have some example questions. Okay, so what is that accounting equation? So make sure you know the accounting equation. The assets equal liabilities plus equity. So if, and I don't know if you had a question like this, but you may have. So if I said that I had assets of 500,000, and let me do a new page. So let's say I ask a question about the formula. Oh, there's equity. Okay, so if I say you have assets of 500,000, you have equity of 300,000. I want to know what liabilities is. So do you know how to figure that out? Plug it into your formula. So we're just taking the difference because remember, this side has to equal that side. So 500,000 equals, looking for that. So it's 200,000 or, you know, any combination of that. So you want to know that. And then asset accounts. So we talked about the assets. They have a normal debit balance. That means if you're looking at an account and the balance, you're going to see usually a positive number. It has a normal debit balance. When you have to do an entry, just keep in mind, if I'm purchasing an asset and I'm putting it on my books, I know that it's got a normal debit balance. So let me go ahead and put that in on my journal entry first. It's going to be a debit. Okay, so these accounts will pull over to the financial statement, the balance sheet. So we have cash, accounts receivable. So remember, accounts receivable is all of those customers that owe you money, or all of those tenants that owe you money. They're set up in the system in a separate module. So whatever you're doing, is usually that position is called accounts receivable. And that accounts receivable person is responsible to put sales in or record the invoices for the new rents for the month. Bill out any improvements that they do in their space if they have to pay for that. So what happens is, on the general ledger, I'm just looking at money. It's just giving me dollars. And in the end, it gives me a total. I have to have a way to know what makes up that total. And so what happens whenever you have an accounting software, you'll have a listing of tenants or customers or clients, whoever it is, depending on your business. It'll be in a separate accounts receivable module. And when you go into that module, you'll have to set up each one of those customers, each one of those tenants. And so when you run transactions through that, it's always tied to someone. So maybe I sold Matthew something that was $1,000 and it's Christopher, right? I sell Christopher something that's $200. So I want to run the report and I say, okay, I know that I have some money out there that's due to me, but who owes me? I can run an accounts receivable report and that gives me a list. Matthew owes 500, Christopher owes 200, your total is 700. And it gives you that report. So the system keeps track of it very nicely. So you know who all of those customers are and who owes you what. Same thing on accounts payable. We haven't gotten that to yet. So I'll talk to you about when we get there, but it's the same thing for accounts payable. You get a listing. So when you see accounts receivable, that is usually what it is. It's talking about people that are buying from you and you're rotating that money out, okay? It's coming, you're billing and it's coming in, you're billing, it's coming in. It's something that's current. It's gonna be usually 30 days. Sometimes people give discounts, so you might get the 2% net 10. Do y'all remember net 30? Do y'all remember that from last semester? You don't remember that? So if you have something that's 2%, 10, net 30, it looks like this. This will be the terms, 2%, 10, or it'll just say 2, 10, net 30. What this means is you get 2% if paid in 10 days, but due in 30 as a full amount. So I can offer that to my customers and they would pay me faster because maybe they want to take the discount. So that's all that means. It's just a term that, okay, I might collect that money in 10 days, but usually I'll get the full amount in 30. Sometimes you'll say the terms of net 45, which just means you have 45 days to pay me. So you have different terms, but usually it's what accounts receivable is, it's like turning around on a continual basis, usually around 30 days. Then we have notes receivable. Notes receivable is different. It's an asset because it's something that somebody owes you. But instead of it being an account that's constantly rotating like that, you have a note receivable is specific to a particular customer or tenant, whoever it is. And usually it's set up with terms that you have this amount you owe me, and I'm going to give you a year to pay it off. And I'm going to charge you X amount for interest. So you can set it up that way. You can also say, okay, I'm going to just set it up to pay me back in 12 months. I'm not going to charge you interest. You can do either way. But that's a notes receivable. Notes receivable usually is a longer period of time. It's set terms. It's going to be the same payment every month, like that. And then we have our building, equipment, land. We could have vehicle in there as well. So those are our assets, our fixed assets. And those are usually the non-current because you're going to have those for a long period of time. That's our assets. So when you see anything in regards to that, you would want to know that you're going to have a normal debit balance for an asset. If there's a question that says, the list of accounts are all accounts receivable except, and so maybe there'll be a list of these and accounts payable thrown in there, and you'll know, okay, that one's not an asset. So just know the accounts. And if you say, okay, if I have a question on there that says that, you know which one is not. Or if I give a listing and say, what is this? Is it asset, liability, or equity? You would know. All right, so our liability accounts, they normally have a credit balance. So when you're looking at that trial balance and you're looking at those dollar amounts, the total should be a credit balance in the credit column. And doesn't always have to be, because sometimes things happen and you may have out of the norm, but for the most part, it'll be a credit balance. And those are also on the balance sheet. So we have accounts payable, and just like I said, with the accounts receivable having its own module in the software, you may have an accounts payable clerk that works for the organization. And that person, what they're going to be doing is taking all of the bills that either come in electronically or in the mail. They'll be entering them into the system, into that liability, that payables module. Now, there's also electronic software now that meshes with accounting software. And so a lot of times what happens is they'll put code in and they know, okay, oh, she gets invoices from Entergy every month. We're going to go ahead and code those where the system automatically grabs those invoices and keys a lot of the stuff in for you already. All you have to do is review it. So just because you're in accounts payable, that doesn't mean that that person is actually typing in things from a bill. It maybe isn't that way anymore. If you work for a large organization, your accounts payable department may be looking at electronic invoices. They're not actually key punching. They're just checking to make sure everything's in. So picture like you have an invoice from, let's say it's from Entergy for an electric bill, and you have to put that into the system. When you do, you have to select who the vendor is. So that's what they usually call vendors. So you have to select who the vendor is. Maybe it's Joe Blow, and he's the one that comes and does the painting. So I have to select him and put painting and how much that is. So when you run an accounts payable report, it'll tell you the name of the vendor, what the invoices are, and how much they're for, and then a total at the bottom. So just like with accounts receivable, you can get a report that gives you a list of everybody. It's the same thing with who you owe. So in the accounts payable module, you can run reports and you can look to see who you owe. Now, sometimes you'll work for organizations that have an accounts payable department, and there'll be different people doing different things depending on how big the organization is. So maybe you have a big organization where they have somebody that's just entering and reviewing all of the invoices and putting everything in. They will also look at the coding of the invoices, and they will put those numbers in. Normally, the process is it goes into whatever department it is that approves. So maybe you have a property manager, or maybe you have a marketing department, or maybe you have a service department, and you have to push those invoices out for those managers to review. And they sometimes look at the coding too and help out. Usually accounting is the final say on where it goes. They always think they know, but they don't always know. So they'll sign off on these invoices and then send them back to you for payment. Well, maybe you're not the one that pays them, somebody else pays them. So maybe you're just the one that's doing the actual coding and looking to see where it goes and putting those in or making sure they're in correctly. And then somebody is gonna go through the process of making the payments out by actually cutting checks. So that process, you sometimes will use those reports. So you'll have a report that has a listing of all the vendors with the amounts and the invoices. The system also has the terms. So you can run it with columns that say, okay, this is within, the 30 days. This is over 30 to 45 days. So you may go through and say, okay, this week, I'm going to pay all of these in this column, but I'm not going to pay these. And then you are able to manage your cash a little bit better. You're collecting on that other report, and then this one you're using to see who you're going to pay. You want to try to pay within your terms. Sometimes you can't have enough cash. You can take the discounts that they're offering. That's always a good place to be in, where you can pay early. So that's accounts payable. So you usually, when you're in the organization and the accounting department, you'll usually have accounts receivable positions, and you'll have accounts payable positions. And then they'll have like staff accountants, people that are reviewing the accounts, making sure things are in the right place, people that are actually doing these adjusting entries that we just learned. So that's kind of what's happening. Then we have our notes payable. So notes payable is just like, the receivable payment, the notes receivable is, something that is going to be paid over a period of time. So you'll have a set term, a set monthly payment. Sometimes it includes interest, sometimes maybe not, depending on what it is. But the notes payable sometimes can be over 12 months. So it's not always on the current liabilities. It can be over 12 months, which means it would be in the non-current section. So maybe you have a note that you're paying to the bank for a loan that you have, and it's payable over 5 years. So that would be in your non-current section. Then we have salaries payable, because we talked about this earlier, that sometimes you have, your pay period may run into the next period. So we have to set up that salaries payable. We have sales tax payable. So when we collect sales tax, let's say I work for an organization and we sell retail products. So I work at a store. And you come in and buy the shirt, you're not just paying for the shirt, you gotta pay for the tax too. Well, I don't get to keep the tax because who's charging the tax? Parish, right? So I put it into, if I collect, let's say $10 on the sales for taxes, the $10 will go into a separate account. It goes into that sales tax payable account. And then at the end of the month, I'll run my reports and I'll say, okay, here's all my sales. Here's all the tax that's been collected. And then I just pass that on. So I cut a check to the parish, to the state. So we have to keep track of that. And then we have the unearned revenue, which we talked about. Remember, unearned revenue doesn't have payable in it, but remember that it could be something that I have to pay if I don't do it, or it's just a service that I have to provide. I've collected cash already, and now I have unearned revenue. Okay, so liability, normal credit balance, and it's on the balance sheet. And so again, just know those accounts. And then the normal debit balances on the trial balance. So we have our asset accounts, our expense accounts, dividends, and losses. This is all what you would expect to see a debit balance, positive number. Normal credit balances on the trial balance would be liability accounts, revenue accounts, gains, common stock, and retained earnings. So those listings should help. You can just memorize which one has debits, which one has credits. That can be helpful. I also have on there which statement they fall on. If they go on the income statement, balance sheet, or the statement of retained earnings. So if I said revenues will show up on the balance sheet, that would be false, right? Revenues and expenses show up on income statements. And I'll put this on Moodle so y'all have it. Okay, so if a company purchases equipment costing $4,500 on credit, the effect on the accounting equation would be, so let's think about what's happening. I'm purchasing equipment. What's equipment? It's an asset, so I'm bringing it in, so I know that it's going to be an increase. Then it says that I'm purchasing on credit. What kind of account is credit? It's accounts what? Payable, or a notes payable in this case, because it might be something big, but it's going to be some sort of payable. What's a payable? It's a liability. Now, is my liability going up or down? Is it increasing or decreasing? It's increasing. And it's increasing, but is it a debit or a credit? Credit. Because it's a liability. Liabilities normally have a credit balance, and we're doing a normal transaction here, right? We're increasing our liabilities, which means now that's going to be sitting as a credit. So my assets are going up, which means they're increasing. And now I'm adding to, I'm going to have to pay more out later. So I'm adding to my liabilities. So my liabilities are increasing by the same amount. So the equation's in balance. My assets went up, my liabilities went up. All right, so classify if it's asset, liability, or equity. So this is just memorizing those accounts. So that way you'll know what it is. So we have the assets, we have a liability, we have another asset with the building. Common stock is in your equity section. Accounts payable is a liability. And then indicate the financial statement on which the following items appear. Is it, it's the income statement or balance sheet? And it just lists those accounts and you would just say which one it is. Okay, this example is, the journal entry is already done for you and you just select which one is correct, unless y'all would rather write it out. No, you'd rather, I don't know if it's more confusing to see all of them there or if it's more confusing having to figure out how to write it. I know on my test in my principal's class, I make them write out journal entries, but I tell them that I'm going to make them write it out. So I expect to see right answers, and the majority do okay, but a lot of people don't. But anyway, on October 27, Able Graphics received a $400 utility bill for the current month's electricity. It's not due until the end of the next month, which is when the bill will be paid. Which of the following journal entries will Able Graphics make on October 27th to record this transaction? So go back to the date and say, what is happening on that date? What am I doing on that date? So it's saying that I'm receiving the bill. So I'm the accounts payable person putting that bill in. So what happens is when I set it up, I'm not paying it right away because it's telling me I'm gonna pay it next month. It's not due yet. So how does that work? Well, if I'm not paying right away, I need to set it up as an accounts payable. It's gonna be due, it's gonna be payable in the future. So I need to get my expense on the books. So remember that number 3, I think it was. So when you're asset, that entry, we said assets go up and then, you know, whatever it is, could be a liability goes up too. This is kind of similar, but instead of dealing with the asset, we're dealing with the expense side, or like those adjusting entries. So what did we talk about? Assets go up, it's a debit balance. Expenses go up, they're debit balance. So kind of keep that in mind. So expense has to be a debit. So we're going to do expense first. It's our debit for the 400. We're not paying it yet, so it's not cash. We're paying it in the future. It's telling us we're paying this next month. So that's why I know I'm putting it in the system and it's going to go to accounts payable, meaning I'm going to be liable to pay it in the future. So I'm looking for accounts payable for that, for the 400. If I said, instead of asking what would the entry be on the 27th, if I said what would the entry be when I made the payment, then that would be a whole different entry, which isn't here. But if I'm paying out cash, cash is going to be a credit. So it would be a credit to cash. And instead of being an expense, I would have already done that part. It would be accounts payable. Because I'm saying, I'm telling you that I put it in the books. I'm not going to pay it till next month. And then if I ask you, well, what happens when I pay it? What's the entry? This would be the entry. I'm clearing out that accounts payable and I'm paying cash. Okay, so if equity is 300,000, liabilities are 192, then assets equal what? Well, this is just what we did. Assets equal liability plus owner's equity. Well, they're telling us liabilities are 192. This is 300. So what's our asset? All we're gonna do is add. Which of the following accounts are temporary accounts that will be brought to zero? So remember that I said we close out our revenue accounts and our expense accounts. Those are your temporary. Anything that goes to the balance sheet, asset, liability, or equity would not close out. So you would just circle all the ones that are correct. All right, the system of preparing financial statements based on recognizing revenues when the cash is received and reporting expenses when the cash is paid. So we talked about 2 different ways we could keep track of the books. Everything you learn in financial accounting is about accrual basis. So if I'm gonna base everything from my financial statements on when I paid out cash and when I received in cash, what is that called? Cash basis accounting. There's two different ones, accrual or cash. Actually, there's more, but for this class, there's two. All right, so a company's list of accounts and the identification numbers assigned to each account is called. So remember, we talked about these accounts will have numbers and descriptions sometimes. And so those are called just a listing of it, not what the balances in the accounts are. If you just want a listing of all the accounts, it's called your chart of accounts. Chart of accounts just list them all out. Here's what you have. So if you're working in an organization and you're in marketing and you have something that you want to expense, you're going to be looking for those advertising accounts. And you'll be looking to see what accounts do they have on the chart of accounts that I think this belongs in. It could be radio advertising. It could be some sort of ad. It could be some kind of account that they have set up just specifically for seasonal decorations. So there'll be a list of accounts. Do we have any marketing majors or just business? Marketing. So if you're in the marketing department, a lot of times you will be given a chart of accounts that are available to you. And so you're going to be looking to see, you're going to be looking to do certain things within that organization for your marketing. And sometimes you might be only doing like the creative stuff, but there's times when you're in an organization that's smaller and you have to put together your budget for the new year. And you're going to have to know, like, what are these accounts and what am I going to be using those accounts for throughout the year? And so when you purchase things or when you have your ads going out or you have something get ready to go on the radio, you need to know, okay, this invoice is coming to me for approval. I have to know how to list it. So I have my chart of accounts and I'm going to be looking at all of the things that pertain to marketing. Are you hoping to look at accounts when you get into marketing? Or are you just hoping to do the creative side? So the girl at our office does a little of both. And she tells me all the time, I hate fooling with the numbers. Like, please help me out. Tell me how much cash I have. Help me figure out what my budget is for this. Where her income's coming in. So anyway. All right, the company paid $12,000 for an insurance policy. It benefits 12 months. So we want to know, what is the expense? And remember, we walked through how to do that. 12,000 divided by 12 gives you 1,000 per month. What is the amount of the expense for 3 months? So obviously, if I just figured out what it is for 1 month, I can multiply it by 3 to get 3. So it should be pretty easy. I don't want this to be too hard. I want it to be kind of easy. Does it feel like it's kind of easy?
Yeah. Are all the questions?
Yeah, they're going to be very straightforward. I don't want to do anything too, I just want it to be easy. Because we'll have some new stuff coming up. So I want y'all to do good on this one. Okay, a law firm billed a client $1,800 for work in the current month. Which of the following journal entries will the firm make to record this transaction? Okay, so they billed a client $1,800 for work performed. Does that mean they didn't do it yet? No, it means they did the work. So they're billing them. That means the client did not give them cash yet. They have to bill them. They're going to pay them later. They're billing on credit. A lot of times the process in the organization is they will run through like credit checks in order to have credit with an organization. They'll have their process that they do. Similar to if you personally want to get a credit card or something. You don't want to just do stuff for people and they can't pay you, right? You'll be out of business real quick. All right, so since they didn't pay us, we have to set up accounts receivable. So we're going to debit accounts receivable for that $1,800 and we perform the service. So that means we have to put it into some sort of revenue, and it's telling me that I'm a legal firm. So I'm going to have legal fees revenue or some variation of that, my account. Okay, so we have an adjusted trial balance. They all have normal balances. So I'm just listing out, here's some accounts, here's some amounts. I'm not telling you if they're debits or credits. And I don't know if I'm going to do this. I did make them do this, but it was very, very simple. An income statement where we had revenue and expenses. So for revenue, we would just go through this list. And you can see there's only one account that says revenue, right? Account services revenue, 10,000. So I put my 10,000 on there. What's my expenses? So I have supplies expense, 750. No other expense accounts. So that's my supplies expense for 750. My net income. So what do? We take revenue minus expenses to get us our net income. So it'll be 9250. And then I know I'm definitely not asking this. This is a statement of the retained earnings. So you would start with your beginning balance, which is on there. It tells you what it is here. Add income, take away your dividends, and you get your ending income. So basically, this just shows you that in order to figure out what your retained earnings are, you have to do your net income first. All right. And then let's look at so this was, let me go back, some questions online. So normally online, I would give like a preview. I didn't do it for this portion because I feel like it was kind of easy enough to, with the study guide and all, that I didn't do the practice test. Come on. But I just wanted to go through some of the sample of questions. So which of the following accounts will not appear on the income statement? So again, know your accounts so you know which one it is. So we got all these revenue accounts and we have insurance expense. But if you look at this particular revenue account, it says unearned revenue. So remember, unearned revenue is not earned yet. So it's not going to be on the income statement because we haven't recorded it as revenue. It's a liability. Accrual basis of accounting requires adjustments when recognized revenues in the periods that they're earned and match expenses. So remember, we learned about the two, accrual and cash basis. So this is obviously true because it's not saying that we're recording revenue when we receive cash or expenses when we pay out cash. If it said that, it would be the cash basis. That is a problem similar to what we just went through on how to solve for assets or liabilities. Okay, a credit always increases account balances. Does it always increase an account balance, a credit? Doesn't always. It does sometimes. So if I had an asset account and I did a credit, is that going to increase it or decrease it on an asset? So think about that trial balance. So we have cash, so we have debit and credit. Notes payable, let's say it's 5,000. Let's just put a couple of accounts on there. So it says a credit always increases account balances. Okay, so when you're looking at the balances in these accounts, so you have two asset accounts and you have two liability accounts. So if I purchase something and it's going to be something I have to pay in the future, I'm going to do a credit to accounts payable because I'm going to have to pay that in the future, which means this increases with a credit because I just bought something. So when I buy it, it goes in as a credit, it's going to increase. Now, when I pay for something with cash and I have to credit cash because cash is going out. So in that situation, my cash is going to go down when I make my credit. Right? Because I have 5,000, but now I have to pay 500 for something that I just bought. So I have to do a credit. That means my account's going down. So in this case, for an asset, when I do a credit, it's not going up, it's going down. If it was accounts payable, the credit would make it increase. If I have, let's say utility expense. So maybe we have 6,000 on the books for a utility expense. An expense account normally has a credit balance, a debit balance. So if I have to add an expense, I'm going to debit. So if I said, whenever I have an expense account, like every time I do a debit, that means my expenses are increasing, or the majority of the time. When I'm doing a debit entry to an expense, it's increasing. That would be true. Okay, so, but if I said, if I do a debit to an accounts payable, it's going to increase, that would be incorrect. Because if I'm doing a debit to an accounts payable, that means I'm paying some of this off, because I'm doing the opposite. So I've paid out 10,000, which means I've decreased it by doing a debit. Okay, so think about that. So just because I'm doing a credit in account doesn't mean it's always going to increase. Just because I'm doing a debit in account doesn't mean it's always going to increase. Okay, so this one says the blank trial balance is a list of accounts and balances prepared before adjustments. So remember, we had that chart. So if we haven't made the adjustments yet, simple, unadjust it, right? And then we have our adjustments, and then we have our adjusted trial balance. So if the question was, if it was after, it would be adjusted trial balance. So you see, they're not too bad. Adjusting entries can sometimes be done to correct accounting errors, but that is not the primary purpose. So remember, we talked about adjusting entries, and adjusting entries are usually to record like depreciation for that month, or record the prepaid expenses or the accrued expenses. But can we fix errors? We can, but it's not really the primary purpose. So this one's asking for a journal entry, and it's giving them to you. So I won't make you write them out. What would the adjusting entry for the following? So office supplies account beginning 500, a physical count is done, showing 201 of unused supplies. So in that situation where it's saying, okay, I started with 500, I have 201 unused. You know that that's left on the shelf. So am I going to use that 201 for my adjusting entry? No. I need to figure out, what did I use? So if I have 500 that I started with and I'm left with 200, you just take the difference. That's what I use. That's what's going to get expense. So we're going to debit office supplies for the $299 and then credit office supplies. The expense gets a debit, the supplies gets a credit. Mask Inc. Well, they might be making a lot of money now. It's kind of funny because this is from like a few years ago. Who knew they would be stuck with Mask this long? Okay, so Mask Inc. trial balance. So it's giving you a list of the trial balance, and it's asking you, what is the net income? Well, how do we calculate net income? Revenues minus expense. So all you have to do is go through and look for your revenues. So is cash a revenue? No. Supplies? No. Accounts receivable? No. So you just go through and find them. So here's an expense, and here's my revenue. So my revenue is 15,000, and then I deduct the 2 expense accounts, and that comes up with your net income. So just keep that in mind. Revenues minus the expenses or your net income. This is another one. Expenses always decrease equity. And that would be true. If you think about what's happening with an expense. So an expense is reducing your income. And if it's reducing your income, that means it's reducing your equity, because that's what's getting rolled into retained earnings, which is equity. So it's good if you understand all of what's happening with the accounts and with the expenses and with the revenues to help answer questions. So hopefully you have a pretty good grasp on all the different accounts. What is in the following is an example of an accrued expense. So it's just giving you different scenarios. So a company owes a salary to an employee that worked in June but won't get paid till July. And that's one that we went over in class. So we have to, okay, that's something that I would have to set up. Can you give me an example of another one? What that would be? What's another accrued expense? Interest can be, yeah. Because sometimes we have to pay that note next month. And we have to accrue the interest expense. Failure to record depreciation expense will overstate expenses and understate assets. So I do like questions like this, like to kind of get you to think. So, so think about it for 1 second. So if we do depreciation expense, and expense is debiting, so it's reducing my income. So if I don't do it, if I don't put it on the books, will I overstate my expenses and will I understate my assets? So if I don't reduce it, that means my asset, remember I said you have a contra asset account that will lower the asset as you do those entries, because that's gonna be my credit. So it's sitting as a debit and I get a credit, but now the credit doesn't come in. So if the credit doesn't come in, it doesn't reduce the asset. So will that understate my asset? It's not gonna understate it. What's happening? It's overstating the asset, because I was supposed to do an entry, like let's say the asset's 10,000. When I do the entry for my adjustment, it's reducing it by, let's say, $1,000. So then the net book value is 9,000. If I don't do that, it's not going to overstate my asset. Understate my asset, because it didn't change. It stayed 10,000. Understating means I would have taken too much away. So that means on my books, I've overstated my asset because I didn't reduce it down. And then it says, are you overstating expenses? Well, no, because I didn't even put the expense on the book. So what happened? I understated my expenses. So it's the exact opposite of what this question is saying. So think about like what's happening. What does an expense do? Like when you go to answer the question, because there may be something similar to that. Customers promise to pay on credit is accounts payable by the seller. So if I'm selling you something and the customer is going to pay me on credit, it's not accounts payable. That's what? What's that called? They're going to have to pay me in the future. I'm going to receive money in the future. Accounts receivable. Revenues will always increase equity. That's true, because revenues are money's coming in, so it's always going to increase that. All right, so that was just some samples. I didn't go through all of them, but that gives you an idea. There'll be questions similar to that, and similar to what you're doing on the homework, because I'll go through those homework questions and just kind of refresh what y'all asked and try to ask questions similar to that. So y'all have any questions on those? I feel like you have to go over one more thing. I just wanted it to be a basic review, just so when we get started and we're going to be doing mostly calculations, but sometimes we'll be looking at, the financial statements too and bringing stuff in. I just want it to be fresh on all the little basics on what we're doing. Questions? Okay. All right, so next week will be the test. So we'll come in and have the test and then we go home.